Accounting for debt number 3, what we've done here is we've just changed our example slightly to add a little bit more complication to the accounting. What you'll notice with this debt instrument is that the par value is 740, redemption is 740, the issue date is the 1st of January 2012, it's going to be redeemed in 5 years' time in 2016. At the end of that year, the only difference we have in this example is we're going to issue the debt at a discount. The debt has been issued at 600 million. So we're going to borrow 600 million and then we're going to pay back 740 in 5 years' time. Now, the way the accountants think about this, this difference in the number between the discount of, at 600 and the repayment at 740 is they treat that difference as interest. But accountants love to spread things. They like to match the cost and the benefit together. So we've got the cost of the loan is the 140 million, I suppose, interest that we pay off in a lump sum at the end of the loan's life. They'll take that interest and they will spread it over the life of the loan. And they'll spread it by calculating a yield to maturity. Now, what we've done is we've already calculated that yield to maturity for you of 9.99%. Next video, Accounting for Debt 4, will show you how that yield to maturity is calculated, but we'll just take it as read as being 9.99%. And the reason it's higher than 5% is the total interest that we need to deal with in the income statement is not just the cash coupon, but we need to spread this 140 million discount, which will be treated as interest, through, we need to spread that through the income statement over the 5-year debt term of the loan. So, going through and following through the same mechanic as we did in the previous example, we've got 4 columns. We've got balance sheet at the beginning of the year, what's the interest charge, what cash will we pay, and what will the year-end figure be. So again, same as before, the issue proceeds, 600, cash comes into my balance sheet, I recognise a liability. Liability goes into this calculation as 600. Interest will be then charged on the outstanding liability using the yield to maturity of 9.99%. So we're going to see an interest charge there of 60 million. That 60 million hits financial expense down below EBIT in the income statement. The cash payment, though, is going to be based on our coupon. The coupon is just a contractual cash payment. It's something agreed between the two parties. And we've agreed to pay 5% back based on our par value during that period. So we're actually only going to pay 37 million. So immediately, we have a difference there of 23 million. 60 million total interest, 37 of it's cash, 23 of it is non-cash interest. And because we are not paying back all the interest that is accrued during the period, what we have is a situation where our liability is increased by 23 million during that period because of the interest that we have capitalized into that loan or bond. Now, 623 becomes the balance at the beginning of the next period. Again, there'll be some interest charged, 9.99% on the amount outstanding. Again, we'll make a fixed repayment based on the coupon. And again, the amount is outstanding is going to increase. And we follow that process through over the 5 years. And what you can see is, as we go across the 5 years, by the time we get to the end of year 5, moments before the redemption, what we've got sat on the balance sheet there is £740 million worth of liability, the amount that we've agreed to repay on the 31st of December 2012. How do we achieve that? Well, what we've done is that we have charged 325 million worth of interest to the income statement. And that number's got bigger and bigger each year, and it's been building up the liability each period because the cash coupon has not changed. We've agreed to pay 37 million back each period. It doesn't cover the total interest. That non-cash interest, the amounts that we don't cover each period, gets built up on the balance sheet. And we can split that 325 up. I mean, we could split that up and actually find out what it relates to. 325 relates to a cash coupon series of payments over the period. Now, that cash coupon payment, there we are, we've got 37 paid over the 5 years. That's 185 million. And also, we have got the discount that is paid on redemption. Now, we are paying back 740. We only borrowed 600. So the difference of 740, the amount we pay on redemption, minus the amount that we actually borrowed, 600, those two added together is where we get our 325 from. What the accounting has done, it's used the yield to maturity to spread the entire interest cost over the life of the loan. So the income statement is reflecting the full economic cost of having that loan or bond or whatever you want to call it, sat on our balance sheet over that 5-year period. Cash flow statement though, what's going to happen in the cash flow statement is it's going to be hit with 37 million each year in operating cash flow. Odd little thing to bear in mind is the redemption of the bond, 740, will go through the financing part of the cash flow statement. And part of that redemption, a bit conflicted here, part of that redemption is interest in terms of how it's being treated in the income statement, but it will go through the financing part of the cash flow statement. And that is how you would deal with a discounted debt item. It's how you would deal with a zero coupon. You are using the yield to maturity as a mechanic or a spreading tool to spread the entire interest cost through into the income statement. Cash flow does what it's told. How much coupon are you paying? Bang, through the cash flow, job done. And if the cash coupon is smaller than the interest charged to the income statement, you are building up the value of that loan or bond on the balance sheet. But it's still an accounting number. All right? So these numbers here will not necessarily reflect what is traded on the market. So fair value is not really having an impact on a corporate's debt numbers.